It's December 2022, and Christmas is right around the corner. The year started with record low interest rates, record high stock markets, and the economy was strong both in the US as well as globally. Since January, the Fed has raised the interest rate from 0.25% to 4% by raising the rate by a record high 0.75% 4 times in a row. How much higher will the rate go? The interest rate has not been this high in 15 years, and it is still rising. But what does that mean for you? How has the interest rate affected people? And how could it affect your life in 2023? Welcome to Investing in a Nutshell, the channel where we explain the world of investing so that you can learn and start your own journey as an investor. Most of us don't spend time caring or even thinking about the interest rates. In most years, you don't see any news articles debating if the interest rate should go up, down, or keep the status quo. There are some situations where you do care. For instance, when you buy a house and need to take up a mortgage. In these situations, you always want to find a bank that can offer you the lowest interest rate. But what is the interest rate, and how does it really work? How is the rate decided? In a nutshell, the interest rate is controlled by the central bank of each country. They use the interest rate as one of their primary tools in order to control the economy. If you want to accelerate the economy, the Fed can reduce the rate, making it cheaper for companies and people to borrow money, which in turn leads to increased spending. Similarly, they can cool down an economy by increasing the rate, making it more expensive to borrow money, which will lead to less spending by businesses and people. But how does the Fed decide if they should increase or reduce the interest rate? How do they know if the economy needs to be chilled or accelerated? The answer is inflation. The Fed has a goal on how much the prices of goods and services should increase over time. If the average price of goods and service increase, it's called inflation. And if the prices decrease, we have deflation. In the US and most of the Western world, we have an inflation target of 2% per year. This is the goal that the Fed is aiming for, and they will adjust the interest rate in order to achieve the inflation goal. In 2021 and 22, we have seen inflation rates of 7 to 9% per year, which is way higher than the stated goal. Therefore, the Fed is increasing the interest rate quickly in order to combat the inflation. But why will a higher interest rate reduce inflation? In the market, the price of any goods and service is based on the balance of supply and demand. If you have too much supply, companies often reduce their prices in order to get the customers and sell their services. If there is too much demand, people will outbid each other in order to secure what they need. By increasing the interest rate, the Fed will increase the cost of borrowing money. This will ensure that many of us will pay more interest, and therefore have less money to spend on any other goods or services. This will reduce demand, and in turn, this will make everything cheaper. Most of us have seen that many of the products we use daily have become more expensive this past year. Butter, clothes, gas, even electricity, especially in Europe. Most things are getting more expensive, fast. Some of you might be thinking, but why is inflation so bad? And it is a fair question. Let's consider a world where everything gets more expensive at an alarming rate. Everything from food, the gym, and getting a haircut. Some of your valuables might increase in value, like jewelry and your house, but your salary will enable you to buy fewer things than before. If this continues, you will have to change your spending pattern, leading you to buy fewer products. When enough of us reduce our spending, it will impact the companies producing the products we no longer buy. Businesses will perform layoffs or even go bankrupt. People will lose their jobs. These poor people have just lost their income, making them spend even less than before. This will have a cascading effect, leading to less spending and more companies going bankrupt, and even more people without a job. This pattern will repeat, and the situation will only get worse. It's easy to see that the world described above, a world with a very high inflation over time, can lead to catastrophic effects for an economy and the people living in that country. Inflation can be seriously dangerous and must be dealt with fast. even if the cost is high. Therefore, the central banks are increasing the interest rate at an unprecedented pace. We will cover inflation and showcase real examples where it has gone out of control in a future video, so make sure to subscribe to the channel and press the like button. It really helps the channel and enables us to reach more people and help them start their investment journeys. So far, we have covered what the interest rate is and how it works. We have also explored inflation and explained why this is the root cause for the sharp increase in the interest rate. But how can the interest rate and inflation affect your life? Why should you care? Any changes in the interest rate can affect us all, but in different ways, depending on your life and your investments. If you have a mortgage with a fixed rate, you will feel every adjustment on your monthly payments. Most homeowners in the US have a fixed interest rate, which means that you only feel the true effects if you need to take up a new loan. But there are other ways that the interest rate can and will affect you. When the interest rate increases, it makes it more expensive to take up a mortgage and buy a house for all potential buyers of your home. This will, in most cases, lead to a fall in housing prices, meaning you will get a lower offer on your property if you decide to sell. Many of us will also feel the effect of the interest rate at our jobs. A lot of businesses are experiencing an increase in costs from their suppliers, in addition to a reduction in revenue from their sales. Rising costs and falling revenue are both bad by themselves, but it can be the end for many businesses when they occur at the same time. For some companies, it will force the management to perform layoffs, and for others, it will lead to bankruptcy. Meta, Microsoft, Alphabet, and Twitter are all examples of huge companies that still make lots of money, but are facing difficulties and are dealing with it by performing massive layoffs. The US is probably facing a recession, and we fear that many could lose their jobs in 2023. Most of you will not lose your job, luckily, and many of you will not take up a new mortgage or sell your house. But you might still feel the effects of inflation and high interest rates if you have any investments in the stock market, in bonds, or even in cryptocurrency. The typical pattern in an economy with increasing interest rates is that stocks will be punished, especially stocks with a high PE ratio. Investors will typically flock to safe havens like treasury bonds until they see that the economy is healed. We have seen this in 2022. The S&P 500, which is an index consisting of the 500 biggest companies in the US, has been down 25% this year. Amazon has been down 50%, and the same with Tesla. In the world of crypto, we have seen similar patterns with Bitcoin down more than 60% this year. This does not mean that stocks will perform poorly in 2023. One could argue that the current market presents bargain prices and that 2023 could become the best year in a long time. No matter how 2023 turns out, it seems clear that the development of the interest rate will have a deep impact next year as well. It all depends on the inflation rate. Will it slow down and come back to normal levels? Or will it stay high, forcing the Fed to keep up with the drastic measures? If the inflation continues, we will all feel it, one way or another, in 2023. We hope you have enjoyed this video, and if you have any question or comment, we love your feedback. We read all your comments. Have a great day, and good luck on your own investment journey.